US markets are up. The India-US trade deal is finally done. Everyone is calling it a big positive for India. But trade deals are never simple. What exactly has been agreed? What gets cheaper? What gets expensive? And most importantly, who actually benefits and who pays the cost? You're asking the right questions because trade deals don't create winners everywhere. They just shift the advantage. Listen till the end, and by then you will know whether this deal strengthens India or just changes who benefits. Let's start with what actually happened. India and the US finalized the trade framework, focus on reducing barriers, stabilizing supply chain, and expanding bilateral trade. The goal is simple: make it easier to sell to each other, reduce uncertainty for companies, lock in long term economic alignment. So, this isn't one announcement, it's a package of concepts. So, what gets cheaper for India? For India, several things become cheaper or easier to export. First, critical import, high-end technology, advanced manufacturing equipment, semiconductors, defense components, and certain energy-related inputs become more accessible and cost efficient. This lowers the cost for Indian companies that depend on US technology and capital goods. For inputs to higher margins, not headline. Now, the other side. India reduces friction on select agriculture products, industrial goods, and specific manufactured exports from the US. Now, that makes US exports more competitive in India. So, yes, some Indian producers will face more competition. Now, let's be clear about the positive. This deal will strengthen India's position to global supply chain, increase investors' confidence, reduce geopolitical risk, align India closer to the global capital. For foreign investors, this is a stability signal. Markets love predictability more than promises. Now, the part people avoid talking about, trade deals also create pressure. Some domestic industries face pricing pressure, margin compression, higher competition, especially sectors that relied on protection will need to adapt fast. Now, this deal rewards efficiency, not entitlement. Let's break it down sector by sector. Likely beneficiary: IT and tech services, electronics manufacturing, capital goods, specialty chemicals, export oriented manufacturing. And what are the potential pressure zones? Low efficiency domestic manufacturing, certain agri linked business, and protected industrial segment. So, this doesn't mean losses, it just means transition. Now, connect this to today's market move. US markets are up, this sentiment has improved. Why? Because this deal reduces the uncertainty at a time when global growth is fragile. Trade clarity and capital flows is a very powerful combination. So, this is not a one day market event, it's a structural shift. The biggest mistake investors make is reacting emotionally to deals like this. The right response is understand who gains efficiency, who faces the pressure, and how supply chains realign over time. Trade deals don't change markets overnight, they change the direction quietly. And today, the direction just became clearer.